The Philippines' GDP grew by a significant 7.6% in 2022. But all this growth comes at a cost, $1 billion cost. The Philippines has spent over 1.1 trillion pesos on infrastructure alone. That's $34 billion. All this spending incurs a significant fiscal deficit. Basically, the government is spending more than it can earn through taxes and fees. So is all this spending worth it? Let's find out. The Philippines' GDP growth is mainly driven by the services sector, which accounts for 56.2% of the GDP. This is followed by the industry manufacturing sector at 34.8%, and the agriculture, forestry, hunting, and fishing sector at the lowest at 8.9%. While their 7.6% growth rate is impressive, the country still grapples with several challenges, like a significantly high unemployment rate, a projected inflation rate of 5.1% in 2023, increasing policy rates, and import and export bottlenecks. There are slums in the Philippines' largest city of Manila. This just shows the need for more economic growth to raise the quality of life for all Filipinos. Another major issue with the country is its susceptibility to natural disasters. The Philippines is the most disaster-prone country in the entire world. These natural disasters not only harm the people of the country, but are also a huge risk to the economy of the country. Luckily for the country, the Asia Development Bank approved a $200 million loan in December of 2023 to further aid the Philippines in developing climate-resistant and environmentally friendly public infrastructure. These funds will contribute to improving economic growth and facilitating access to employment, markets, as well as public services like education and healthcare. Moreover, Japan's largest investment bank, known as Nomura, anticipates a bright future for the Philippines. They expect infrastructure development in the Philippines to increase even more in the coming years post-2023. This is thanks to the Marcos administration's initiative to increase annual spending to pre-pandemic levels. In March of 2023, the economic team of the Marcos administration showed plans for the rollout of 194 flagship projects, amounting to 9 trillion Philippine pesos. This is roughly $161 billion. That is a lot of money. The government is going to have its hands full funding all of that. But on the bright side, 45 of these 194 projects will be financed through collaborations with the private sector. But the government needs to attract more private entities if it's going to fund even most of these projects. Successful public infrastructure projects are key to attracting more funding from the private sector, even from companies outside the Philippines. This will no doubt help the Philippines deal with its deficit, because the country has been dealing with money shortages ever since the pandemic. They've increased public-private partnerships to tackle these challenges. In the Philippines, they plan to use these partnerships for 32% of major projects, adjusting laws to make them more transparent. But to develop the infrastructure of the country, you need a workforce. The Philippines faces a challenge here too. One big challenge is workers needing new skills as automation becomes more common in the fourth industrial revolution, affecting over 40% of Filipino jobs. But there's also a very strong argument to be had about how automation can replace jobs, depriving people of work. Will this be the case for the Philippines? Although 17% of jobs might get replaced by machines, 18% more jobs are expected to be created. This leads to a 1% net gain in jobs because of automation. But it's not going to be easy. Certain industries, like accommodation, food services, transportation, warehousing, retail, manufacturing, and construction are most likely to be affected. Jobs in these areas could see significant changes due to automation. To adapt to this change, there's a need to redesign jobs for Industry 4.0. This means making traditional roles and tasks more digital. A crucial skill to learn is data science, especially in sectors like manufacturing, where 61% of jobs have the potential for automation. Roughly 50% of other sectors, like transportation, accommodation and food services, agriculture, and retail and wholesale, can be replaced by automation. In the future, industries and jobs are expected to change, so workers will have to prepare themselves for these transformations. These improvements have not gone unnoticed. International investors are eyeing the Philippines for money-making opportunities, and it looks like the Philippines is welcoming them with open arms with their changes to the Foreign Investments Act. Before we get into these changes, be sure to leave a like and subscribe if you're enjoying this video so far. Now let's talk about how the Philippines is incentivizing foreign companies. It happened on March 4, 2022. The government of the Philippines changed its Foreign Investments Act to increase employment and growth in business sectors. What this act basically does is that it allows international investors to fully own their small and medium-sized businesses with no conditions. They'll hold 100% equity in the firm. Before, they'd have to hire 50 Filipino workers to allow this. On top of that, investors only need a minimum of $100,000 to start up the business. It used to be double that before at $200,000. But this does come with a caveat that 15 local workers have to be hired, and the firm has to introduce some sort of advanced tech to the country. This will no doubt help fight the unemployment rates of the country as well as propel it further into the future. But the Philippines wasn't always doing so well when it came to attracting foreign investors. The 2019 Organization for Economic Cooperation and Development Index shows that the country had the most restrictive laws when it came to foreign investment in Asia. There's also uncertainty about the policies for the country, red tape, corruption, and the ever-present poor infrastructure. Another issue is the protectionism that runs rampant in the country. The earlier laws allowed local businesses to be protected from foreign powers. A good portion of the economy consists of conglomerates. Mostly family-owned, they dominate a lot of industries, like real estate, retail, and communications. In order to get around these rules and tap into the market, foreign businesses would opt for joint ventures with local businesses or franchising. But they had their fair share of complaints and accusations of protectionism and bad management in the process. While this was fine at the time, COVID-19 made it worse. The GDP went down by 9.5% in 2020. Foreign direct investment dropped to 24.6%. That's a decrease from $8.5 billion to $6.5 billion. This understandably convinced the government to finally implement some reforms to their flawed system. While foreign investment will help reduce the deficit, will this be enough for the country? To find out, we need to look at the government budget of the Philippines. A government budget is the amount of money the government has on hand to spend. This increases with tax and payments. When a country spends more than it earns, though, its budget goes into the negative, and the budget deficit of the Philippines has been in the red for many years now. Their average budget from 1988 to 2022 was about negative 2.64%, but their budget reached an all-time low of negative 8.6% in 2021, which showcases how much their economy was struggling in this year. There is hope, though, as the country might return to pre-pandemic levels of budget. For instance, their budget went up to negative 7.3% in 2022, showing an upward trend. And the pattern seems to persist in 2023. In October of 2023, the government's budget deficit dropped to $611 million. This is a 65% decrease from the $1.78 billion deficit of the 2020s. Their total revenue went up by 34%. Revenues from both tax and non-tax sources grew significantly, while government spending only went up by 8%. Although there's still a budget deficit, the government is spending more than it earns at a slower pace this time. But most of the revenue is still from tax collection, about 92% of it. But non-tax income rose about 22% compared to 2020. This increase in its budget was mostly down to government deposits, managed funds, and the state's share of the income from the Philippine Amusement and Gaming Corporation. And the future is looking bright for the Philippines. Forecasts show that the budget is going to increase by negative 6.1% by the end of 2023, and it's only going to get higher and higher as the years go by. Forecasts predict it'll go as high as negative 3.8% by 2025 if the Philippines continues in this way. With that said, it's clear that the Philippines can overcome its deficit and progress towards a brighter future. Their economy is on the right path, but only if they can keep up those public-private partnerships and legislative reforms. But let us know in the comments if you think the Philippines has a bright future ahead. Leave a like, subscribe for more, share with your friends, and be sure to check out these videos on screen.